Hi, everybody. My name is Logan Metcalfe. I'm here to do a financial analysis today on three different companies for my Financial 381 class, fall semester. Um, Today, I'm going to talk about my three companies. I have Ralph Lauren, I have Stryker, which is a medical company, and I have Hornbeck, which is our class decided on an oil company to do together. Ralph Lauren, as everybody knows, that's clothing and other stuff like that. What we're going to talk about today, we have three different questions that we're going to look at. We have the first one is going to be, which company will I make a 6-month loan to? The next question is, which company will I make a 5-year loan to? And our last question is, which company will I buy 50% of and put my time and interest and everything into? For the first one, we're going to talk about who I would give the 6-month loan to. We're going to look at the current ratios of the three companies to depend on who is the best. Right here, I did a chart on all three of them, Ralph Lauren, Stryker, and Hornbeck, for their current ratios. And right here, it looks as if Hornbeck is at the top the most. But for this 6-month loan, you want to see which one you can find the lowest of these current ratios to get your 6-month loan for. So the lowest one right here is I'm going to see is you're going to be your Ralph Lauren company. They look like they have the overall best current ratio. Next, we have the quick ratio. Once again, you have Ralph Lauren at the bottom of the chart, which is where you basically want them to be for the better person of this 6-month loan. Once again, Hornbeck is the highest, and Stryker is in the middle. Next, we have the cash ratio. Again, we have Ralph Lauren at the bottom. They look like they're doing the best overall in all these cash. Over the 5 years, they are doing the best on pretty much every ratio that you see, because I guess they're the biggest company and they've been doing it for a long time. So for my 6-month, $1 million loan, I chose Ralph Lauren because they look like the overall best company that would be able to pay their loans in time and to give me the best benefit that I think would be good for them. For that, you're going to do current ratio equals your current assets divided by your current liabilities. For the quick ratio, you're going to find the current assets minus inventory divided by the current liabilities. And for the cash ratio, you're going to do cash minus current liability divided by current liabilities. And that's how you're going to find the charts that I just showed y'all in order to find your 6-month loan. Next, we're going to have who I would give the long-term loan to, for the $1 million 5-year loan. You're going to look at your equity multiplier ratio. And for this one, you're always going to try to find which one has the highest number on the charts. That's going to be your one that's going to be your best bet on trying to give a loan to, who's going to pay it the best. And on this chart, I have Ralph Lauren Company, of course, is at the top. Out of these two companies, Ralph Lauren is definitely the bigger company that I chose. So they're always going to be the one that I'm probably going to pick on all three of these because they've been doing this the longest and they're the biggest company and they're going to be able to pay me the best to look at my loans. Next, I have the times interest earned ratio. That's what you're going to look at, also known as TIER. And once again, Ralph Lauren is on top. So, like you guys said, Ralph Lauren, I'm going to pick them because they've been doing it the longest. So, for my 5-year, $1 million loan, like I said, you found the total debt ratio is your total liabilities divided by your total assets. The debt minus equity ratio is going to be your total debt divided by total equity. And your times interest earned ratio is going to be EBIT divided by interest. And for my 5-year loan, I will pick Ralph Lauren once again. This is the long-term debt and total assets ratio that I was talking about. Right here, I have Hornbeck at the top, I have Stryker in the middle, and I have Ralph Lauren at the bottom. And like I said, on these graphs, you want, for the long-term loans, you want the very bottom one, which is going to be your one that has the less stuff. And right here I have long-term debt equity ratio. Once again, Ralph Lauren is at the very bottom. Hornbeck is at the top, and Stryker's at the middle. Stryker is a very interesting company. That's the company that I would like to work for in the future. It's a medical sales company, and I'm very interested in them. That's the main reason why I picked this company to do my project on, also because they interest me. Then next, I have the long-term debt and capital ratio. Stryker is going to be in the middle. Ralph Lauren at the very bottom, which is what you're looking for. From 2010 to 2014, they pretty much stayed low. I mean, they pretty much stayed the same, and then from 2012 to 2013, they went down a little bit, but they went back up come 2014. Next, we're going to look at what I would buy 50% of and put my time and interest into. It's a very big deal because nobody wants to put their time and interest into something and lose all their money on. So you really have to look at all the charts. You really have to look at a lot of information to put in what you want to do and what you need to do to be successful in what you buy. So you're going to look at your return on assets, which is going to be what the company returns on the most and how they get the most money and everything. And right here, you're going to find that Ralph Lauren is pretty much at the top, like always. Hornbeck is now at the bottom. They aren't very good at getting the return on their assets. And Stryker's in the middle, as always, where they stay. So the next, we're going to look at the return on equity. Ralph Lauren and Stryker, the first 2 years, they went back and forth. One started up, one started down. Then they traded places, and then Stryker immediately went down. And Ralph Lauren went up and then plateaued and stayed the same from about 2012 to 2014. And like I said, on these two, you really want to look at the one who's on top, which is Ralph Lauren. And then here's your price-earnings ratio. This is, like I said, from 2010 to 2014, Stryker pretty much stayed at the bottom. Besides, on 2014, they went to the middle. Hornbeck stayed up high. So, I mean, on this one, you really choose Hornbeck. But overall, I think my 50% of the company that I would put into would be Ralph Lauren because they overall are the best company that I chose. Not too much of a competitor for the companies that I chose. For this, you're going to find the return on equity equals the profit margin times the asset turnover times the equity margin. And then for the return on assets, you're going to do profit margin times asset turnover. And then for the price earnings ratio, you're going to do market price divided by earnings per share. And that's how you're going to find pretty much what you want to do to help you buy into the best company that you want to get. And that's it for my video today, guys. Hope y'all learned a little something on these companies. Hope y'all learned a little something on assets, current ratio, cash ratio, and whatnot. I enjoyed doing this project, and thank y'all for watching. Have a good day, everybody.